If you're just starting out investing in the stock market, you may be tempted to follow the crowd into very speculative stocks in search to get rich quick. Before you do that, please watch this video to learn about my top 10 stocks. What's up, guys? It's Jeff. Today I'm talking about my top 10 stocks, why I like them, and where I think they're headed. To be clear, I'm an investor, not a speculator or a day trader. I invest in high-quality companies where I think there is significant upside in the medium to long term. If you're new to the channel, please subscribe and make sure to hit the notification bell. I put a lot of effort into these videos, and all I ask in return is for you to sit back, relax, and smash that like button. It really does help the YouTube algorithm, and I really appreciate it. And as always, I'm not a financial advisor, and this is not financial advice, just a summary of my thoughts. So to make my top 10 list, the stock needs to meet a few criteria. Number one, I need to be able to see a path towards doubling my money over the next 3 to 5 years. Number two, they need to have a proven business model that has favorable competitive dynamics. Number three, the industry must be facing long-term growth trends. Number four, it needs to be led by a strong management team with a preference for founder-led businesses. And finally, number five, it needs to have limited downside risk and asymmetric returns, which is just a fancy way of saying more upside than downside. So these are my top 10 stocks in no particular order, but arranged by themes that I think will see significant growth over the next 5 to 10 years. So theme number one is digital migration, which is basically e-commerce and online advertising. So the first on my list is Alphabet, and you might recognize this as the parent company for Google. Now the ticker here is GOOGL. Now don't buy GOOG because it's actually more expensive and you don't get voting rights. So why do I like this? Well, let's look at the competitive dynamics. They really are incredible for Google. They're essentially a monopoly. They own English search and video search through YouTube. You know, through any metric that you look at, they're north of 80% market share on a global basis. I continue to see strong growth in search, and their expansions into new lines of businesses outside of search should also pay dividends in the long run. And those include things like artificial intelligence, cloud, and self-driving. Their balance sheet is pristine. It's absolutely one of the best in the world. And why this is so important is that it allows them to survive during times of crisis, but more importantly, it allows them to be consolidators in their industry. Alphabet also has an incredible management team led by Sundar Pichai. The downside risk here is really less business risk, and the biggest threat really is from government intervention. Now, we've seen them get fines in the EU, and the biggest risk here would really be antitrust action in the US. So overall, when I look at the core business alone, I think it's enough to keep up with the S&P 500. And then you get that additional upside from all the other business lines. So this is just a fantastic business. It's one that you buy and hold for the long run, and you add whenever the stock price goes down. The second on my list is Facebook, ticker FB. Here's why I like it. The competitive dynamics here are very similar to what I just walked you through in Google. Now, obviously, Facebook isn't social media, but they are really the dominant force in social media. They have by far the most market share, and they have no real competitive threats. Now, when you look at the advertising industry more broadly, it really is a duopoly between Google and Facebook. Amazon is a new entrant, and they're gaining a little bit of market share, but for the time being, Google and Facebook really dominate that industry. When I look at advertising more broadly, I think social media will continue to be a really important force for at least the next 5-10 years. The balance sheet here is pristine. Again, these are one of the best balance sheets in the world. The management team is very strong. It's led by founder Mark Zuckerberg, and Sheryl Sandberg is a very strong manager, and she's a great complement to Mark Zuckerberg. The downside risk here, very similar to Google, is less about business risk and more about antitrust or government intervention. I think, in conclusion, their move into shops is something that can really be a game changer. Now, we just walked through Amazon being an entrant into advertising. And what Amazon did was they built up their business as being an e-commerce business, and they said to themselves, well, why don't we go into the advertising industry? Facebook has taken it from the other way around, where they've become this massive advertising company, and they've said, well, why don't we take advantage of that and go into e-commerce? Third on my list is Alibaba, ticker BABA. Now, this is the Chinese internet behemoth that does everything from cloud computing to social media to fintech and digital payments to, of course, e-commerce. They're widely known as being the Amazon of China because of the market share that they have, which is north of 50% for all online sales in China. But really what's interesting here is that Alibaba's imitated a lot of the best features from US tech leaders. So of course you'll see a lot of elements of Amazon in their business, but you'll also see some elements that are taken from eBay, from Google, and from Facebook. So overall, they're going to have, in my opinion, very strong long-term growth across all their different platforms, including e-commerce, advertising, and subscription services. Their balance sheet is pristine. Again, it's one of the best in the world. Management team is also very strong. Now, Jack Ma, who's the founder, recently stepped down, but the day-to-day is still run by Daniel Zhang and Joseph Tsai, who've been around since the beginning, so they're in very good hands. Same thing here. The downside risk is less from a business standpoint. It's much more the potential for government intervention. So like Facebook, I think this one's got a ton of growth ahead of it. When you look at the Chinese consumer, China has over 4 times more working adults than the US. So the opportunity set there is just massive. And what's important to remember is that Alibaba does sell into the US via places like Amazon and Shopify. And so that leads me to number 4 on my list, which is Shopify. And the ticker here is SHOP. For those of you who aren't familiar with Shopify, it's essentially an operating system for businesses that want to sell online. They really are the leader in the space. What they offer is mission critical, and there's huge switching costs. So essentially what happens is when someone wants to build an online business, what they do is they go to Shopify, and Shopify helps you essentially build out the entire backbone of your business. So everything from the website to marketing, payments, checkout, shipping, they really do it all. So it's such an important and valuable tool for people that are looking to sell online. And then what you do is you advertise on Facebook, and you can source your product from Alibaba. So you'll see in this chart here, the ecosystem is quite powerful, and it's actually one of the reasons why I like all 3 of these stocks, Facebook, Alibaba, and Shopify. Now, online retail is really just in the early innings, so there's a ton of growth ahead of us. The balance sheet for Shopify is very strong. It's not quite as strong as the first 3 because of its size, but they do have net cash of over $2 billion, which means they've got $2 billion in cash more than they have in debt. Management team here, very strong. Tobias Lütke is the founder and CEO. He grew this from nothing, and he's still at the helm. The downside risk here, the biggest risk I see is the valuation, which is sky high right now. But long term, the partnership they just announced with Facebook for Facebook Shops really is a game changer for them. It can turn them into a viable competitor to Amazon. So, I think this is one of the stocks on this list with the highest growth potential, but just be very careful of your entry price. Make sure that you pick that very carefully. Now, moving on to theme number 2, fintech and digital payments. So number 5 on my list is Square, ticker SQ, but I could have just as easily picked PayPal. Now, what I like about Square here is they've got a really unique business model with 2 major lines of business. So the first one that you see here on the left is for sellers. It's their point of sale system. They also have a full suite of services that you can see around that. Then the next line of business is for individuals, where they've got the Cash App. Now, this is a really unique ecosystem. It looks a lot like Venmo, where you're able to make payments on a peer-to-peer basis, but you can do a few more things here. You can buy Bitcoin, you can buy stocks, you can do all kinds of different things. So it's a really, really powerful app, and it's gained a lot of popularity. So when you look at their business more broadly, it's super sticky, high switching costs, and mission critical. And they're able to add value-added services like direct marketing, and because they know the cash flows of a business, they can provide easy access to lines of credit. So as opposed to you having to go to a bank and jump through all kinds of hoops and wait for months before you have access to lines of credit, with this, Square's customers can just press a button and essentially get a line of credit very quickly. So there's a potential here for a paradigm shift where small businesses would bank through Square as opposed to banking through traditional lenders like banks. The Cash App also has incredible potential. It's already seen wide adoption. And like I said before, it's very similar to Venmo, and it doesn't have that social media aspect to it, but it does have enhanced features like paycheck deposit and the ability to buy cryptocurrency like Bitcoin. So with Square, you get a really strong management team that's led by Jack Dorsey, who is the founder. The downside risk here is obviously we know what we're going through in the economy right now. Small businesses are expected to continue to suffer. Now, it might be for only the next 3 to 6 months, but it could be extended, could be longer, like a 12 to 24 month period. So that is something to be cognizant of. But overall, I think this is one of the biggest growth potential stocks on this list, just like Shopify. And again, just like Shopify, one of the biggest risks here is their valuation. So just be very mindful of your entry point. Number 6 on my list is MasterCard, ticker MA. But again, here I could have considered Visa as well. And what I love about this is the competitive dynamics. It's essentially a duopoly with Visa. Between the two of them, they have about 80% market share. And so the industry theme here is a really strong one, which is move away from cash. And what's even better here is the business model. And for those of you who don't know, credit cards don't take on any credit risk. What happens is the issuing banks are the ones that take the credit risk. And Visa and MasterCard essentially are just the toll bridge for transactions. So they get a cut of every single transaction that takes place within their ecosystem, whether it's online or offline. In both cases, the balance sheets are absolutely pristine, very strong management teams. The downside risk here, similar to Square, is the economic uncertainty. So overall, much like Google, this one is just about as good as it gets from a business model standpoint, a competitive landscape standpoint, and industry growth. So again, this is one you buy and hold for the long run, and you add to your position when the stock price goes down. So moving on to theme number 3, which is cloud migration. So number 7 on my list is Salesforce, ticker CRM. Now this one's a little bit different than the first 6 because they do play in an arena with very strong competitors, but they are the market leader within the CRM space. And that is a very sticky product that's also mission critical and comes with super high switching costs. So they're in a very nice place from a competitive standpoint. They've experienced north of 20% growth in the last few years, and I would expect that to continue. The other thing worth noting here is if you're familiar with the rule of 40, essentially, if you add the revenue growth and the EBITDA margin of a company and it adds to above 40, then you know you're dealing with a very high quality company. And Salesforce does have over 40. So from a competitive standpoint and from a business standpoint, Salesforce is about as good as it gets. Their balance sheet is extremely strong. That's important here because it allows them to be a consolidator in a space with a ton of opportunity. The management team here is incredible, and it's led by founder Mark Benioff. The downside risk here is, that they are in an area with strong competition. So there is potential for newer, better product to come around. But I think the real downside is just slight margin compression, or realistically, that the growth just slows down over time and it becomes more in line with the S&P average. But when you look at that upside, which is continued 20% plus growth, I think the upside downside is quite attractive. So moving on to theme number 4, transportation as a service and green energy. So it should come to no surprise to you that number 8 on my list is Tesla, ticker TSLA. Now the competitive dynamics here are less favorable than the first 7 that I've talked about. They really do have a lot of potential threats because it seems like every single car manufacturer is trying to get into electric vehicles, and all the big tech companies are trying to get into self-driving. Now, the difference here is Tesla has a massive head start in electric vehicles. They've scaled up, they've built an incredible brand, and they've built out the infrastructure for energy delivery into the vehicles. Traditional car manufacturers just don't have any of this, and frankly, they don't have the DNA, right? Because Tesla was built from the ground up to be an electric vehicle company with green energy in mind. None of these other traditional car manufacturers have that, so they need to retrofit, which is really, really difficult to do. When you think about their long-term vision, I go back 20 years to Amazon. For those who understood that Amazon wasn't just an online book retailer, they understood that the long-term vision was much greater than that. The same thing is present here right now for Tesla, is that, in my opinion, it's not just a car manufacturer. They're really active in artificial intelligence, green energy, and software. And so the long-term opportunity here is really to disrupt the entire energy and transportation ecosystem. So think about a world with no gas stations, no emissions from vehicles, and virtually no fatalities on the road from human error. Now, the other great thing here is that you're buying into an amazing management team, and one of the visionaries of our generation, Elon Musk. Now, the downside risk here is that the competition catches up in electric vehicles and that one of these other tech firms comes up with a better self-driving mechanism. But overall, I think the upside potential here is tremendous. Long term, I would expect this to be a multi-$1,000 stock, but in the short term, I'm really being careful about my entry point. I don't really want to pay more than $800 a share. Theme number 5, which is 5G. Number 9 on my list is American Tower, ticker AMT. Now, for those of you who aren't familiar, American Tower is a REIT, or real estate investment trust, that owns cell towers all around the world. Now, I love the competitive dynamics here because it's essentially a duopoly between American Tower and Crown Castle, who both have about 35% market share. And then the third is SBA Communications, and they're a distant third with about 10% market share. So from a long-term dynamic standpoint, when you think about mobile and 5G, it's really an incredible long-term growth opportunity that should last for at least the next 10 years. What's nice too here is that there's plenty of room for consolidation and continued global expansion. Now the balance sheet looks a lot different than the first 8. It's a good balance sheet, but unlike the others, these guys have a lot of debt. They've got about $30 billion in net debt. But the nice thing is that their business model is very strong and they've got plenty of cash flow to actually pay that debt. So there's really no issues servicing it. Management team has proven that they can build a global leader and they've continued to see long-term growth. And, the major downside risk here is that the stock is very expensive. So again, be careful on your entry in this one. And now finally, theme number 6, stock market inflation. So I've talked about this in previous videos. My own view is that the Fed money printing is going to lead to inflation, but it's not the type of inflation that you would expect. It's not, an increase in the price of consumer goods like milk and bread, but rather it's an inflation in financial assets, so basically stocks. So number 10 on my list is Markel, ticker MKL. This is an insurance and investment company. It's known as Baby Berkshire. And the reason for that is it has the exact same business model as Berkshire Hathaway. Now, this business model is absolutely incredible. And let me walk you through it very quickly. But essentially, an insurance company takes in premiums from its customers and then pays out claims against those premiums. Now, the difference between the money they take in and the money they pay out is the insurance float. And if they're good underwriters, that's going to be a significant amount of capital. What they're able to do with that insurance float is then invest it in the stock market and invest it into buying private companies. That's exactly what Berkshire Hathaway does, and it's exactly what Markel does. Now, the only difference is that Markel is way smaller. It's about 10 billion market cap versus Berkshire, which is north of 400 billion. So I think buying Markel is similar to buying into Berkshire Hathaway 30 or 40 years ago before they got so huge. So basically what you get is a turbocharged mutual fund with one of the best money managers of all time. Their balance sheet is very strong. They've got more cash than debt. The management team is also very strong. Tom Gaynor is widely seen as being the next Warren Buffett. They've got an incredible history of value creation and of outperforming the S&P 500 that you can see on this chart here. The downside risk here is essentially that the stock market goes down, so the value of their investments goes down, and that their insurance payouts are a little bit higher. So I've put here a chart of what they expect the insurance payouts to be. So overall, I think if you want to play the upside to the stock market, this is really the smartest way to do it. Now, there's 3 stocks that are noticeably absent from my top 10. Those are Apple, Amazon, and Microsoft. And the reason that I didn't list them in my top 10 is that I actually get exposure to them through Markel. If you remember what I said before, Markel actually invests in the stock market, and Apple, Amazon, and Microsoft are 3 of their biggest positions. So that's my top 10 list. I'd love to hear from you guys what your favorite stocks are. So please comment below. Love to hear your thoughts and your stock picks. So here's a few bonus picks for those of you who stuck around to the end. Number 1 is Netflix. Now, a lot of you know exactly what Netflix is, so I won't go through their business. But when you think about their business, they are mostly in the US only right now. So the international growth potential is absolutely massive. Think about the opportunity set in places like India and China. Now, the only reason this didn't make my top 10 list is because of increasing competition and high valuation. But I do love this stock and I do own this stock. The next one is NVIDIA, which is ticker NVDA. Now, for those of you who don't know this business, they really are a leading chip maker in really all of the hot areas that are part of, the themes that I really like. So artificial intelligence, 5G, and gaming. The next stock is JD.com, ticker JD. Now, very similar to Alibaba, JD is known by many as being the Chinese Amazon. Now, their business model actually resembles Amazon's more closely than Alibaba because they have distribution centers within China, and so they have got a lot of logistics. The difference is I like Alibaba a little bit better because it's a much bigger company and it's got more exposure to different sectors within China. It's also has the leading market share in online commerce in China. So I like to get my China exposure through Alibaba. But JD.com is a great pick, and it's one that I would probably look to buy if it were to go down in price. And then finally, the last one here is Goldman Sachs. For those of you who don't know what they do, this is the leading U.S. investment bank. They're one of the greatest money-making machines ever created. So they're not only a leading investment bank, but they're also one of the leading hedge funds and one of the leading private equity firms. So that's it, guys. I hope you enjoyed today's video and found it helpful. If you did, please make sure to like the video. And as always, thanks for watching, stay safe, and have an awesome day.